You should feel alarm before the numbers make sense to you. The hook is simple and shocking because you already suspect political choices can wreck livelihoods. You hear it immediately. Turkey's president thinks high interest rates cause inflation, and that belief rewrote policy in ways that shocked global markets. But here is where it gets interesting, because what followed was not theory, but an experiment with real human consequences. You need to understand the theory that drove the policy choices you witnessed. Erdogan's idea flipped conventional economics on its head and suggested high rates somehow cause inflation, rather than tame it. You are told in speeches and interviews that lower interest rates will encourage production and lower prices. And that belief became the engine of policy choices that dismantled orthodox central banking in Turkey. You must remember that orthodox economics treats interest rates as a tool to fight inflation, not a cause of it. Central banks typically raise rates to cool demand when prices run away, and they rely on independence to make those hard decisions. You will see why removing that independence by insisting on lower rates during inflation is dangerous, because it changes incentives for investors, savers, and international partners who depend on predictable monetary policy. You are watching an economic experiment begin in earnest when political pressure mounts on technocrats. Erdogan publicly declared his opposition to high interest rates across multiple speeches and interviews. You then saw the institutional consequences, as governors and policymakers faced pressure to conform and financial markets began to price in political interference instead of economic logic. You should know the timeline that turned rhetoric into policy, because dates matter when money collapses. The central bank cut rates dramatically even as inflation accelerated, a move that would later be widely criticized by economists. You must track how quickly cuts accumulated and how markets responded, because each cut chipped away at confidence in the lira and emboldened capital flight and currency speculation. You will find the idea of negative real interest rates is central to this story, and that term matters for your savings. When inflation outpaces nominal interest rates, your money loses purchasing power while the central bank pretends it is stimulating growth. You should imagine your savings shrinking month by month, and then understand why people began buying dollars, gold, and crypto as alternatives that preserved value better than the lira did. You must picture the lira's exchange rate in stark terms, because numbers tell part of the human story. The currency slid from roughly 4 lira to the dollar to more than 20 lira within a few years, erasing vast amounts of wealth. You should feel how an 80% currency loss translates into higher import costs, higher prices for food and energy, and a shrinking standard of living for households on fixed incomes. You will understand that official inflation numbers themselves became part of the narrative because statistics affect trust. Turkey's official inflation rate surged above 80%, according to recently released figures, and everyday prices jumped even higher in many cases. You must remember that many people experienced inflation differently, often facing higher effective price increases than headline numbers reported, which intensified social frustration and economic anxiety across the country. You should see the human choices that followed economic damage because money is trust and people act on mistrust. Large numbers of Turks began buying dollars, euros, gold, and cryptocurrencies as practical hedges against lira collapse. You must understand how this dollarization of private savings accelerates currency depreciation. Because when people move out of local money, demand for it falls and downward pressure intensifies on exchange rates. You will read about capital flight as a predictable consequence rather than a surprise. Investors and savers moved funds abroad or into hard assets, and international confidence in Turkish financial stability eroded quickly. You should think about how capital leaving the country deprives the economy of investment, forces higher borrowing costs, and creates a feedback loop where bad expectations become self-fulfilling prophecies. You must not gloss over the political consequences within institutions because power dynamics reshape policy. Erdogan dismissed or pressured several central bank governors, replacing them with officials more aligned to his theory about rates. You should note that 4 central bank governors were fired or resigned within a 3-year span, and those purges signaled to markets that the bank could no longer be trusted to act independently. You will grasp why central bank independence matters as a democratic and economic principle, because independent institutions anchor expectations. When politicians micromanage monetary policy for political ends, the rules that stabilize markets become negotiable and uncertain. You should understand that eroded independence directly increases the risk premium investors demand, raising costs for borrowers and deepening the currency's downward spiral in predictable ways. You must appreciate the perverse incentives created by negative real interest rates because they encourage consumption over saving and risk over prudence. Businesses and households found it cheaper to borrow in lira for short-term projects, rather than save for the future. You will hear how these incentives fueled a construction boom and other sectors that acted as hedges against inflation, shaping an economy that looked superficially busy but was vulnerable underneath. You will notice the construction boom became a political and economic prop for growth claims because visible building projects masked deeper instability. Developers and politically connected firms benefited from cheap credit and rising asset prices, while ordinary people faced higher living costs. You should question how sustainable growth looks when it relies on credit. Fueled construction rather than productivity improvements, because the latter requires stable prices and credible institutions to attract long-term capital. You must examine comparisons to other countries when ideology overrides monetary prudence, because history offers lessons you can recognize. Venezuela and Argentina both experienced similar patterns where political goals superseded central bank mandates, leading to hyperinflation and currency collapse in some cases. You should understand that these are not identical histories, but the common thread is clear. Undermining monetary institutions invites distrust, which often produces runaway inflation and economic pain for ordinary citizens. You will follow the narrative into policy responses, because governments in crisis try many remedies under pressure. Turkey experimented with unorthodox mix of controls, subsidies, and attempts to boost exports. But these moves often treated symptoms rather than underlying causes. You should evaluate how temporary measures like subsidy increases or administrative price caps may buy political breathing room, but rarely restore long-term monetary credibility without institutional reform. You must recognize that people adapt in ways governments cannot easily control, because economics is practiced at the kitchen table as much as in boardrooms. Turks shifted savings into foreign currencies, gold, and cryptocurrencies to preserve value against the lira's decline. You should imagine the social consequences as households change consumption and saving habits, prioritizing immediate needs and resilience over long-term investments that once underpinned social mobility. You will observe how businesses coped with volatile exchange rates and higher import costs, because companies faced real operational dilemmas. Import-dependent firms saw margins squeezed. While exporters sometimes benefited from weaker currency, but suffered from supply disruptions, you should understand the uneven impacts across sectors and regions, which often translate into political tensions and calls for targeted relief that further complicate macroeconomic policy debates. You must consider the international reaction to a currency in free fall, because foreign investors and central banks watch closely for contagion risks. Global markets price in perceived institutional damage, and correspondent banks may increase hedging costs or limit exposure to Turkish assets. You should think about how higher foreign borrowing costs and fewer inbound investments create a feedback loop that makes recovery more expensive and politically difficult to manage. You will want to know what a credible path back looks like, because rebuilding a currency is as much political as technical. Restoring central bank independence, committing to orthodox monetary tightening, and rebuilding trust with transparent communication are necessary steps to stabilize expectations. You should also accept that these steps may be politically costly in the short term, because higher interest rates and fiscal discipline can slow growth and provoke social discontent before recovery becomes visible. You must weigh the trade-offs of returning to orthodox policy frameworks, because voters and leaders face real dilemmas. Tightening monetary policy can restore credibility, but often exacerbates unemployment and short-term pain for households already struggling under inflation. You should understand that the political calculation of leaders often determines whether painful but necessary reforms are implemented, and those calculations can decide the speed and durability of recovery. You will confront the moral dimension of economic management when leaders prioritize ideology over livelihoods, because policy choices have human costs. Authoritarian control over institutions can short-circuit deliberation and suppress dissenting expertise that might otherwise avert catastrophe. You should reflect on how accountability, rule of law, and professional independence in economic institutions are not abstract ideals, but safeguards against policy choices that can destroy savings and livelihoods. You must examine the longer-term cultural shifts that currency crises produce, because trust in money can take generations to rebuild. If people default to foreign currencies and alternative assets, financial market segment and domestic monetary policy loses potency. You should consider how lasting distrust changes behavior, investment patterns, and even political alignments as populations seek stability in alternative institutions and assets. You will also note the regional implications when a country the size of Turkey destabilizes economically, because neighbors and trading partners feel the shock. Trade flows, tourism, and regional investment patterns shift when a major economy becomes a source of volatility. You should follow how contagion fears affect regional currencies and investor sentiment, making geographic proximity an amplifier of the initial crisis in interconnected markets. You must confront the broader lesson that institutional independence protects economies from political cycles, because central bank credibility is a form of social capital. When political leaders override technocratic institutions for ideological purposes, they gamble with that capital and often lose it. You should carry forward the idea that the core lesson from Turkey's Lira collapse is not just about one leader's theory, but about the fragility of trust when institutions become instruments of partisan policy. You will end by considering alternatives and what a credible recovery might require, because solutions blend economics and politics. Restoring central bank independence, credible fiscal consolidation, and transparent communication are necessary components of a long-term plan. You should remain skeptical but hopeful that with institutional reform and political will, a country can rebuild monetary stability, though the social scars of a collapsed currency can persist for years afterward. You must reflect on the philosophical twist that money is ultimately a social contract, because currency value depends on shared belief and institutional backing. When politics corrodes that backing, the contract frays and people adjust their beliefs in ways that are hard to reverse. You should leave with this lesson. Protecting institutional credibility is not merely technocratic nicety, but the foundation of everyday economic life, and losing it can mean losing the currency itself. You will find the final thought both a warning and a call to vigilance, because similar patterns can appear in other countries under different names. When ideology overrides evidence and institutions become instruments, the consequences spill beyond statistics and into people's daily survival. You should carry this investigation as a cautionary tale about the price of sacrificing institutional checks for political expediency, because the stakes are always measured in livelihoods and trust. You will leave with practical questions about accountability and reform, because rebuilding trust requires clarity about responsibilities. Who will protect institutional independence? How will officials be held accountable? And what safeguards can prevent future politicization of monetary policy? You should consider supporting civic structures and independent inquiry as part of the long-term solution, because democratic and institutional resilience are the best bulwarks against policy mistakes that destroy currencies. You will end with a memorable outro to hold this story in your mind, because narratives stick when they ask you to act. If this episode gave you a new perspective on how politics can destroy a currency, then subscribe and stay curious about the institutions that shape our lives. You should keep watching, because the interplay between politics and economics will determine the next crisis and the next lesson for generations to come.